Hello, everybody, and welcome to today's My Games recruitment show, where, as you can see, we are talking to business owners about how you can become retirement wealthy much sooner. Now, Mike, this is going to be a fantastic show today, is it not?
Well, they're all fantastic shows, Kirsty, if you
I know,
don't
but I'm
mind
really
me
excited
saying
about
so.
this.
But this one in particular, because as most of you know, I believe that a business should serve the people that own it. And part of that, one of the magic three alongside of income, freedom, is wealth. In other words, to have enough money to be able to say, do you know what? I've had enough now. I'm going to step back or I'm going to go altogether. That freedom to do that comes from money, to having a personal worth which generates income that you can live off until you die. That's the bottom line. And it's the single biggest disappointment in many business owners is that it's not really what they wanted it to be. And you've got control over that. And the reason I wanted Alan to come on the show, he's a wealth manager. He's going to introduce himself very slightly in a second, but his job is to help people achieve their financial expectations. So this isn't a pitch or anything like that. We don't do that. This is an important part of, as a business owner, one of the people you have in your inner circle is a wealth manager, because they will do that for you. And that's what Alan is. So welcome to the show, Alan.
Thank you very much for having me.
Oh, the old sound's gone a bit there. Are you okay?
Yeah, just
There
got
you
ever
go.
so a little bit quieter, but it's fine. I'm sure we'll sort it out in a second. So, right, can you just say hi for us again, Alan?
Yes, hi.
Wow.
Nice to be here. Is that
There we
speaking
go.
loudly enough? Okay. Yes, thanks for having me on, Mike. Looking forward to the conversation.
It's going to be good.
So, Mike, do you want to talk a little bit about the sort of things that you find most important when it comes to being a business owner?
Yeah, just building on what I said, really, you want to end up with a personal wealth that's not dependent upon the sale of your business, because the majority of businesses, particularly recruitment companies, because we've got the data on it, but I suspect lots of other businesses don't have a sale value which is going to be enough to give them that freedom and security for the rest of their born days whilst they're sitting on a beach in Acapulco. So you have to look at the business slightly differently. Now, that might happen, and that's a pleasant surprise. You can have a slightly bigger mansion, in the Caribbean, if that happens. But if it doesn't happen, it's cool, because you've taken the second route. Now, everybody knows how keen I am on the cash cow lifestyle business model as opposed to scale for sale. And you can have both. But I do think this idea of taking money from the business, building a business to generate profit, take it out and invest it privately in a portfolio that will just get bigger and bigger and bigger until it reaches the point where you can say, I'm out of here, is the way forward. And I know that Alan, one of the reasons I invited Alan on the show, as not only is he an expert in wealth, he shares a very similar view with that. So it's the way forward, I think.
Yeah, it is. I mean, I can relate to this, first of all, as a business owner myself. So that's the first thing. I'm running a business, and I think what you said there, Mike, I think it's worth kind of just even repeating, because in my experience, and I've been advising predominantly business owners for nearly 20 years. My business has been up and running, and this decision, or this conscious decision to say, I'm either running a lifestyle, you call it cash cow business, it's fine, we're not going to grow huge, we're not going to take over the world, that throws off a lovely income for me and my family, I'm going to salt some of that away for the future. You're either that, or the other one, which you refer to as scale and sale, that's we're really going to go after growth. We probably aren't going to have a lot of spare cash around to save, frankly, because a lot of that's good money, the addition of profits are going to be reinvested for more marketing and recruiting and hiring, all that sort of stuff. That's a riskier strategy. As you say, it happens far less often than people actually think, that people can really go after significant growth in a business and someone else is going to come along and write them a huge check at the end of the day. So rule number one is decide what you are, because what I've seen over the years is people who are a bit of both. We're kind of going after some real growth. We're putting money into marketing and strategies and so on, but not enough to really grow and get a significant size. And at the same time, not really saving anything on my own private account as well. So that can end in unsatisfactory outcomes several years down the line. So just decide, what sort of business am I? Yeah, there's no good or bad. One is not better than the other, But once you're very clear, then you can decide your next action.
Well, interestingly on that, and I know we've got to press on fairly soon, but interestingly, if you decide to go the cash cow lifestyle route to begin with, it's relatively easy to convert that later into a growth business, into a scale for sale business. It's relatively simple because you need to do certain things to get the business so that it works in a certain way. And actually, an element of that is scalability, right? Because the lifestyle means it's got to run without you, else it's not much of a lifestyle. So as soon as you can do that, funnily enough, you then have the opportunity, if you want, to make it scalable. So my view is always, if in doubt, if you're not clear, is start with scale for sale and see how the heck that works out for you.
Start with scale for sale, did you say?
That was a trick, actually, to teach you a little bit, Alan.
Caught you out there.
Yeah,
Start with lifestyle.
Yeah, start with cash cow lifestyle.
Business. The point of being the very phrase cash cow means that it's throwing off cash, which means it's profitable, which means that in itself becomes attractive to future buyers. But you've got your plan A, which is you've accumulated private wealth just in case plan B never comes off, which is someone else comes along and buys you. Because obviously selling a business as well, it's a lot to do with timing. You might want to sell it whilst, like we might be doing right now, going into a deep, dark recession and no one wants to buy your business, certainly not for the price you want. So always having plan A, which is I'm okay even if I just walk away from this business. That's a nice place to be.
Yeah,
so,
it is. And you're right.
I think we've made the point. You just be clear, because then that's going to inform so many of the decisions you make as a business owner in terms of how you grow, what you grow, how you even withdraw, take money out of your company, if indeed you do take any money out of the company. This is
now on that. We discussed previously. You have sort of a big power of three thing when it comes to this, and I really want to get into this. So, what are the three things that help you to create this sort of environment that you live in?
You mean how you can become wealthy in less time, as it
Pretty
says on
much,
the title? Yeah.
Get rich. It's just to be clear, this is not any get rich quick scheme. This is get rich slowly, but you can get wealthy. And then the whole other thing about deciding what do you actually mean by get wealthy. But we've distilled after all the years, and the finance and businesses, so it can be hugely complex. But in my firm, we've just distilled the whole thing down. I like that. I like the power of three. I can remember three things, and they are these. There's three things: it's plan, portfolio, and partnership. And that, in my opinion, that's kind of the secret sauce, the magic recipe. If you can get all those things, and obviously we'll go in and unpack what I mean by each of those in a moment. If you get all of those working sort of cohesively together, your chances of achieving wealth, in the way you define it, are significantly greater than if you just hadn't bothered, or if you even just did one of the three or two of the three. You need these three component parts: plan, portfolio, and partnership, running together as an underlying strategy in order to achieve.
This isn't just about the money. This is the wealth at the time that you want it. So it's not when you're 90. This is about you choose a time that's part of the planning process and an amount of money, and then everything spans out from that, isn't it?
Well, I mean, shall we just go in and
let's go into plan. I just want to say as well, as we're going through, we are very lucky to have Alan here today. So if anybody has any questions, please feel free to put them in the comments and I'll bring them forward with Alan. But yes, Alan, if we could start with plan, that would be fantastic.
The plan is, it sounds a pretty dull word, plan or planning, but this is all about just identifying what good looks like. It's a bit like using a bit of a cliched example, but if you're going on a long journey, because the rest of your business life is potentially a long journey, the rest of your life hopefully is a long journey. If you're going on a journey, you need to know your destination, right? You need to know where you're going and how you want to get there. So point number one within a plan is really to identify what wealthy means to you. Now, in my experience, it comes down to one word, which is lifestyle. Is that two words? One word, two. But lifestyle is one word. Lifestyle. So in an ideal world, in your beautifully crafted sort of dream lifestyle, tell me what that is. What does that look like? What would you be doing on Monday morning? And interestingly, over the years, all the business owners I haven't met one so far that says, I'll be on a beach every day, drinking pina coladas every day. We might be for some time.
Because you never asked me, Alan. I'm not being funny, but
there is one, this Mike. No, generally people, but they've got the traditional concept of retirement is a bit outdated because people they want to do a bit of work, they want to take the summer off, they want to go traveling, but so that's the point. First point. Tell me what good looks like. Tell me if you didn't have to show up, you weren't running your business anymore, what would you do? Because then we can begin to put some numbers around it. I've known people who their passion is hill walking, for example. A good pair of boots, and the rest of it is they're off and running or walking. And I've known other people who are big into sailing, yachting, ocean-going yachts. There's a different sort of lifestyle and a different sort of resource expectation, right? So let's work out talk about your ideal sort of lifestyle, and that leads us to this great thing called find your magic number, right? Figure out your magic number, because that number is the amount of accumulated assets or wealth, and we'll go into what I mean by assets in a moment, but it's sufficient assets which throw off enough income passively so you don't have to do anything. It's just money that hits your bank account every week, month, year without you lifting a finger. So once we know what your lifestyle is, we can then begin to reverse engineer. If we find that in order to achieve that lifestyle, you need, and I'll make up a number, you need £1,000 a week, you need £100,000 a year, whatever it might be. It doesn't matter. It's up to you to decide. It's your lifestyle. It's your life. Then we do some, and in our firm, we've got some very sophisticated financial forecasting software, and we kind of just work through the numbers, and we say this. So your magic number is X, and we say, well, how far are you away from that now? Well, miles away, light years away, or I'm not far away from it. And the point is to work out how we bridge the gap. Sorry, Mike.
Sorry. Having been through this process, not with you, but with another IFA years and years ago, I'm going to tell you that this is a crucial thing, because you think it's one thing, and the way in which it went when I had it done for me, and I've had it done every single year for the last 20 odd years, really, since the 90s, is that the level of questions that they ask and the things that they think of, which will cost you money in the future, and therefore you need to be able to cover and compensate for, is significant. And your world changes all the time, and what you based on how you intend to invest your money, and therefore what return you'll get, will again impact it. And it's quite a complicated thing, but it's so important. So your magic number, you get two choices. You can guess, and you may or may not get it right. You may make it too big, so you work longer than you need to, or you make it too small, in which case retirement's going to be a fairly frugal affair. Or you can get it right. And my advice to you is get it right. Get it planned properly. Use the software or whatever, anybody's software, to make it happen. But get that magic number right, because everything spans from there, in my experience. And certainly that's how it was for me.
Yeah. And so
what I'm saying, Mike, is once you know what this number is, I think just in my experience, the way the human brain works, we've now got a target. We've got something to go after. So if you know that your number was, not just make up a number, if you needed to get to accumulate £1 million in some sort of investments over the next X number of years, and today you had £50,000, well, that's the gap. How are we going to best bridge that gap? But if it meant that, would you know what, I need to, this is where we can segue into the next part, if you like, Kirsty, because this has come to, if you said, well, in order for that to happen, I need to extract, again, I'll make up a number, £50,000 from my business each year to salt away, to invest and grow and so on. You might say, well, I might not be able to do that right now. Well, is there an opportunity for you to, to increase your fees or change the revenue model or do something in order to, in other words, if you know what you need to do, then you've got to say that, then that's, I often say, well, I've done my bit up to that point. I can help and guide and so on, but it's up to the business owner to say, how can I extract this amount of money? Because I'm either going to have to put in this money to this account, or I'm going to have to defer, because the other things about the timing part, I'm either going to take longer. If I'm going to salt away a bit less money because I can't take more out, then I'm going to have to defer my walk away money or my retirement for another 5 years.
This is an important point that's on the screen now, is I think once you know that number, and I do this with a lot of clients, I don't do the working out the magic number, but once you tell me what you got to do, then we can very quickly design the business. We've got models that do it. Lots of people have. I can model a business that tells you what you're going to have to shape your business to be to deliver that. That changes everything in your head. And I know we need to move on now, but I tell you, design your business like it says there to deliver the life that you want, not the other way around.
Yeah.
Okay, so now can we move on to portfolio and what you mean? So we've got an idea of what our magic number is. We kind of have a vague timeline and we have a vague idea about how much we're going to need to do and what our business is going to look like. Then what do we do with all that information?
Right. So the word portfolio is quite a broad definition in terms of what I mean here. So the first thing is, if you want to build your plan. You've built the plans. You now need to fuel the plan. You need to put resources into the model, into the structure, in order to achieve this future thing. So first things to think about is I'm probably going to have to take money out of my company. This is more of an accounting thing. And I hear a lot of accountants often say, "Oh, leave the money in the company. It's tax efficient." Or if you take money out, you're going to get you're going to pay income tax or some sort of tax on it, which is often true, but you can be quite tax effective. So one of the things is working with your accountant or with a good financial planner, work out the most tax effective, tax efficient way to withdraw capital from your business and then to deploy it into something else which is tax efficient. Now, at a headline level, and everyone's heard of things like pensions and ISAs, and they're pretty dull and boring, but you know what? They really work. They're really effective. You can put money straight from your company into your own private account and as a pension plan. You can also do one for your spouse. You can even do them for your kids. And the government gives you a wonderful tax break for doing it. Now, you're not allowed to touch the money until you're 55 from the current rules, or go to 57. So if you've been younger than that, obviously you've got a few years off before you're allowed to access it. But that's a good thing. So they're very, very tax effective to put money into this a pension structure as a tax wrapper, as we call it. And ISAs as well. You can put nowadays. You put £20,000 into an ISA per person, so you can get quite a lot. You can accumulate quite a lot of savings each year by extracting money.
By the way, I buy ISAs every single year. I take money out of other investments and buy ISAs. My maximum allowance every single year. It's I'd say one of the best investments that I make. Really, is that.
It's very simple, very effective, and they are effectively tax free. So you can grow, and then an ISA, you can get your money out anytime you want. Not that we'd want you to, because it's designed for your future, savings, but very, very tax effective. And if you were in a lucky enough position to be able to extract more than you're allowed to put into pensions and ISAs, then there are other slightly less tax efficient, but nevertheless pretty good ways to.
But just on this thing, because I have this conversation with business owners all the time. Their accountants say, "Oh no, leave the money in because that's tax efficient," which on the surface that it is. But there's two problems with that. Firstly, if it's in the company and there's a problem with the company, it's the company's money. So your wealth would go with it if there was a real problem. But also the value of compound interest, which I know we're going to talk about now, enormous. I don't know, those people have heard of Warren Buffett, one of the richest men in the world. Someone said to him once, "Why are you so successful?" "Well, compound interest," he said. It's the magic thing, isn't it? It's the magic ingredient. It is your friend, but it really should be earning you wealth outside of the business, because that's your money then. That's your income on income. And I think I would always argue, talk to the accountants to figure out the best way to get the money out, but get it out. Get it in your own estate as soon as you can.
Like all things, there's a balance. You don't want to just strip your company out of all the resources of cash that's got in the business.
For recruitment companies, we advise 6 months operating costs at all times in cash. Right? Some people want 9 or even 12. Well, that's fine. No less than 3. So as long as you've got that, any other extra money, quite frankly, is a waste. Might as well take it out.
Exactly. And certainly if you're sitting in cash, look at what the position is right now. Inflation is, 9%, something like that. What do you get?
You're losing 9% a year of what you got in the bank.
Yeah. In purchasing power. This is all about preserving your purchasing power, because when you are buying the margarita on the beach in 10 or 20 years from now, it will cost more than it costs today. So we need to preserve that purchasing power, and leaving money in cash in the business is certainly not doing that. You're locking in a guaranteed loss of purchasing power. So be thoughtful, be strategic, extract some funds in a tax efficient way and allocate them to tax efficient wrappers, ideally. And then the next thing is Mike, that's fine in terms of where the money goes. What do you invest in is the thing. Now, primarily, there's really only 3 or 4 things that you can invest in at a headline level. So, cash being one, that's not really even investing. But the others are property. And as Brits, we love property. Everyone I speak to wants to invest in property. And the shares. You can also invest in bonds, gilts and bonds, where effectively you're lending your money either to the government or to companies. But I would just tell you that it's what you want to invest in is what are generically called real assets. So real assets are things which throw off an income and/or you can assume a capital growth. So really, that's owning. If you own shares, so you own a tiny piece of Apple and Amazon and all the other companies around the world, then you're going to participate in their growth, their dividends, all this sort of smart people who are doing great things because you're a shareholder. Now, just to link those things together, Mike, the thing about compounding, there's a thing called the rule of 72. If you've heard about that, you get a calculation, and you just divide the number of years that you're going to be investing for by the rate of return that you can get, and it tells you, it gives you an answer to something, and what it does is, to be specific, using the S&P 500 as a proxy for investing in shares. That's the biggest 500 companies in the US market. US market counts for, I think last time I looked, about 60% of the global market. So it's a good proxy for investing in shares. That has, since that first came into existence, this index, the S&P 500, or this earliest version of it in the 1920s, it has compounded at over 10% a year. Of course, some years it's been 20%, some years it's been minus 30%, but at an average of about 10% a year. If you invest in something which grows at 10% a year using the rule of 72, it means your money will double in about 7 years. So if you can double and double and double every 7 years by doing nothing, incidentally, by allocating money to the great companies of the world, as we call it, and sitting back or running your business or doing whatever you want, the chances of you achieving your magic number are clearly significantly greater than if you left it in cash or did other things.
Yeah.
So but the other thing, I want to just talk about property briefly. People love property, and property it hasn't historically grown at as fast a rate. Everyone thinks it has. It can do. Often people like property because you can borrow money against it, and it's very tangible. You can look at it and see it, and go and visit your property. But particularly for business owners, I think there's a thing called hassle factor or buying property. If you're running a property and you're lending, I know you can have agents to run them and all that sort of stuff, but that takes away from your return and your yield that you get. And honestly, if I'm running a business, I want to just run my business, and then any spare money, I don't want to be speaking to somebody because they've got burst pipe at 3 o'clock in the morning.
Can I just say on this, right? I know we've got to press on, Kirst. One last thing. I've got several properties, quite a few of them really, and I have someone manage the whole thing. It still comes back to me. And we were being sued recently. No, it's gone away now. But honestly, the hassle involved with it, I still got the properties and we're keeping them for various reasons. But in comparison to, we invest in indexes myself, which is baskets of funds really. That's provided a lot better return and less hassle. But I think a balance, have both if you like, but do something really. I know we need to press on.
Yeah. Okay. So I feel like we've figured out a magic number. We've discovered what we need our company to do. We've now got to the place where we sort of allocated our money in various places in a portfolio. Can we discuss this next one, which is a little bit more elusive to me, what partnership means to you?
Yes. So the partnership, this is the concept, and again, particularly for business owners, because being a business owner can be quite a lonely existence. And I think, and my experience is that having almost like an inner circle with a trusted advisor that you can have conversations with, who understands the commercial reality of running a business, but also understands the technical aspects of investing, of tax, of business management, and so on. That has proved over the years to be very, very important to certainly the clients that we've worked with. And I would advise anyone, certainly if you're running a business, to work with a professional planner. The experience in the relationship is quite different, in my experience, to accountants and lawyers, who do tend to be, I don't want to be too sort of broad brushstroke of this, but they can often be quite transactional. Whereas working with a financial planner, it's a far more sort of consultative, relationship-based business, and it will also, a good financial planner will know your personal circumstances, will know about the family setup, and then if you've got children, what you're trying to do, and having that kind of blend across both your professional and personal life, I think is very, very important. And the phrase I've used in the past is having a critical friend. Somebody who's a friend is going to talk to you and coach you and support you, but they're also going to tell you if you're making a mistake. If you're about to do something that's going to blow up the plan, or it's going to just be detrimental to your financial security and financial future, you need to be comfortable that they're going to tell you, no, I believe you're doing the wrong thing. I think that's super, super valuable, because human beings were just not wired correctly. We've got this fight or flight mentality. As soon as something's a bit risky, or the stock market falls, we sort of run to the hills and we sell all our funds and our investments. We often will do the wrong thing without a trusted professional coach in your life.
Can I just come in on this one? Because I've spoken about this before on this show many times. To have that somebody in the inner circle who does all of those things, it doesn't have to be a wealth manager. We had years ago, our accountant was that. three-dimensional thinker, took an interest in the business, very proactive. You could go to him, trust him, lots of ideas and thoughts, a really good person to have in the inner circle. And I think if you can get your accountant in there, you absolutely should. They're very often a bit more transactional than you would like. But certainly the thing with the wealth manager is, because if you pick the right one, they're going to have an eye to your eventual aim, that you eventually want this lifestyle, and they're helping you to build it. They make their money because you pay them a fee, or they invest for you, or both, right? But it doesn't matter. What you get is what you want. My wealth manager retired last year. I was with him for 30 years, right? 30 years. And Les was like a non-paid, non-exec director for me. That's what he was. And very much in the inner circle. And I credit a lot of why I'm now and what I'm worth now to him and the advice that he gave me. But not just that, advice around the business. And it's just someone in the inner circle. And I think the partnership thing, although you said a bit more difficult to define, Kirsty, it's an absolutely crucial, I think, element to growing your business.
I think it's probably the most underrated one. I think when people think about how to make yourself wealthy, I don't think many people would think of having somebody like that in your inner circle as being as powerful as it is. I think
if you get the wrong one, they'll just try and sell you stuff all the time. Well, honestly,
you've got to get the right partner. But if you look at the very best sports people in the world, they've got coaches, haven't they? They've got people. They're good at playing tennis or golf, whatever it might be. But they've got more than one. They've got a small army of them. I don't know anyone, especially in business, who's achieved great success by themselves. Done everything by themselves, run the business by themselves, didn't take advice from anyone else. You can't. There's that phrase. You can't see the label of the jar that you're living in. You can't give yourself objective advice. You're too emotionally attached to the outcomes. And so that's why you need somebody who's just objective and professional, but friendly at the same time. So you obviously might
right wealth manager. You obviously pay for a service, the investment service, which is fine, but for free, you also get this other stuff as well, which I think is magnificent.
If you get the right one.
If you get the right one. Okay, so I think this has been a fantastic show. So let me just, before we round up in a second, Mike, next week, you're gallivanting off on your holiday. So it's going to be Pete and myself talking about content. I've got the Content King, yes, we're going to talk about, Pete and I are going to talk about how you can use it to win new clients and win revenue, because a lot of people have content, but they don't know how to use it.
No, it's the point of having content is to use it to make money, basically. And that's what we're going to cover in next week's show. So looking forward to that.
Yes, indeed. So if I may summarize, guys, so essentially what you need to do to become independently wealthy is, first of all, figure out what wealthy means to you. Figure out, are you going to ask your kids to help them buy a house? Are you going to send your kids to private school? Do you want to go on holiday 3 times a week? Do you want to pay at the most expensive golf course around the corner? Whatever it is to you, figure out what it is and then put a timeline on what you want to do with it. Then make your business work that for you. Design your business so that it does that for you. Once you've done that, you take that money that you don't need, that's not your war chest. You keep your war chest in your business, which is that kind of 6 months running costs. And then the rest of it, you take out in various tax efficient ways and you make it work for you in however many ways you can. And never, ever forget that compound interest is probably going to be your best friend. The rule of 72, I love. Double my money in 7 years. Sorry, I got overwhelmed. And then finally, the most powerful one in many ways is to have somebody, that critical friend, which I love, somebody who's going to tell you straight, if this is your end game, this decision is not going to help that, or this is a new thing I think you should know about. There's someone's going to be proactive in your circle and is going to be a partner with you in your growth thing. Is that a decent round off, do you think?
Works for me.
Fantastic. Thank you very much. So, Alan, as people know, when we watch this show, we like to make it very practical. We've given a lot of information today to people. So somebody's watching this and think that's a lot to do. What's the very first thing? What is the first thing that I should do as an individual in order to make this work for myself?
Well, the first thing, everything really hangs off this thing called the magic number. Once you know your magic number, you can begin to take steps towards it. You can either have a go at doing it yourself if you really want to, or you can then you can hire somebody, the whole range of things. But the first thing you can do is find your magic number. If you're good at Excel, you can do that. If you're not, I think there's a few online tools that people can search for.
We have a tool if people want it. We have a document. It's just a PDF. I'll send it to you.
Right.
But it's full of disclaimers because it's not really your actual magic number. It's just some numbers put together. Give you a finger in the air. But I just wanted to come in on this one as well, because we don't allow people that come on the show to advertise or promote what they do. They come on, they add value, which is the whole point of it. And And there's no difference in this show today with Alan. Thank you very much for coming on the show, Alan. But this magic number thing is so crucial. And I know the difference it makes with my clients when they know what it is and what that means to them and what their business has to do. The change in the way in which they see their business is phenomenal. Makes my life a good deal easier, helping them to scale up for sure. So 2 things. If you just want to connect with Alan, then the best thing to do that is on LinkedIn. And you can see the stuff that he talks about. He's got a podcast. There's lots of things you can get involved with there. But also, he's offered a free consultancy where you can probably get a good idea as to what your magic number will be, finger in the air. And then if you want that magic number to be nailed, so it's 100% right, then you'll get a discount because you come from this show. So you have to mention to him that you came from this show, and he will build that for you. It's entirely up to you. This isn't a promotion, but I just want that magic number to be in your heads and what that means to you. Because if you can do that, everything changes.
Fantastic.
Absolutely.
Yeah, so I think we just about time to round off today. So first of all, I want to say a fantastic thank you to Alan. That's been so informative. It's been really great. So thank you so much for coming on the show, Alan.
My pleasure. Thanks for having me on.
Been great, Alan. Thank you. Yeah,
it has. And thank you to Mike, just for just being a legend, really.
Yeah.
And the shirt choice today, which was obviously, the right thing for me.
Well, I've gone for stars, you've gone for flowers. It's a story. And then once again, thank you to our viewers for watching and sort of being here, listening to us on my show.
And I'll see you in 3 weeks. So Kirsty will see you next week. And thanks again, Kirsty, for the Kirsty Ames show.
Thank you.